As we enter the year 2024, financial experts and pundits have been closely watching the economic landscape, anticipating potential crises and market fluctuations. Among those who have been vocal about their concerns is Peter Schiff, a renowned economist and financial commentator. Schiff, known for his contrarian views, has recently made alarming predictions, suggesting that what's on the horizon for 2024 is far worse than the housing crash of 2008. In this video, we will delve into Peter Schiff's insights, examining the factors behind his grim outlook, and exploring whether his warnings are warranted. Before we delve into Peter Schiff's predictions for 2024, it's essential to understand the backdrop against which he is making his claims. The housing crash of 2008 serves as a haunting reminder of the devastating consequences that a financial crisis can have on individuals, families, and the global economy. The 2008 housing crash was triggered by a combination of factors, including the proliferation of subprime mortgages, risky lending practices, and the securitization of these high-risk loans. When the housing bubble burst, millions of homeowners found themselves underwater on their mortgages, leading to foreclosures and a massive devaluation of real estate assets. The crisis resulted in a severe recession, a global financial meltdown, and a prolonged period of economic hardship for many. Peter Schiff gained prominence for his early warnings about the housing bubble and the impending financial crisis of 2008. He correctly predicted the collapse of the housing market, the ensuing stock market crash, and the subsequent economic recession. His accurate forecasts earned him the reputation of a financial guru who could anticipate market downturns. Schiff's predictions were not limited to 2008. He continued to voice his concerns about the Federal Reserve's monetary policy and the growing national debt. While some of his predictions did not materialize as he expected in the years following the financial crisis, his ability to foresee the housing bubble collapse lent credibility to his economic analyses. Now let's turn our attention to Peter Schiff's recent warnings and what he believes is brewing on the horizon for 2024. Schiff's concerns primarily revolve around the following key factors. One of the primary drivers behind Schiff's concerns is the rising inflation rate. He argues that the Federal Reserve's aggressive monetary policies, including near-zero interest rates and massive quantitative easing, have fueled inflationary pressures. The consequence, according to Schiff, will be a significant erosion of purchasing power for consumers and investors alike. He contends that the official inflation numbers do not accurately reflect the true extent of price increases, particularly in essential goods and services such as housing, healthcare, and food. Schiff points to the fact that the United States and many other nations have become over-leveraged, with high levels of government debt, corporate debt, and personal debt. He argues that this over-leveraging makes the economy extremely vulnerable to any shocks or disruptions, such as a sudden increase in interest rates or a global economic downturn. A sudden spike in borrowing costs could lead to a debt crisis with severe consequences for both individuals and businesses. Schiff's concerns extend to the value of the US dollar. He believes that the excessive money printing by the Federal Reserve and the expansion of the money supply have devalued the currency. According to Schiff, the dollar's declining value not only erodes purchasing power, but also undermines its status as the world's reserve currency. A loss of confidence in the dollar could have far-reaching consequences for the global financial system. Another point of contention for Schiff is the presence of asset bubbles in various markets, including stocks, real estate, and cryptocurrencies. He argues that these bubbles have been artificially inflated by central bank policies and speculative frenzy. When these bubbles burst, Schiff predicts a severe market correction that could surpass the magnitude of the 2008 housing crash. Geopolitical tensions and conflicts also factor into Schiff's grim outlook. He believes that the deteriorating relationships between major global powers such as the United States, China, and Russia could escalate into a full-blown conflict. Such geopolitical turmoil could have devastating economic consequences, including disruptions in global trade and financial markets. Peter Schiff's dire warnings may leave some wondering whether he is simply exaggerating the risks and painting an overly pessimistic picture of the future. It's essential to consider both sides of the argument to form a balanced perspective. Critics argue that Schiff has a tendency to be overly bearish, and his predictions have not always come to pass as he foresaw. They point to the years following the 2008 financial crisis, during which Schiff predicted hyperinflation and the collapse of the US dollar. Instead, the US experienced a period of relatively low inflation, and the dollar remained the world's primary reserve currency. However, Schiff's defenders argue that while some of his specific timing may have been off, his overarching concerns about the long-term consequences of monetary policy and debt accumulation have been valid. They contend that the massive stimulus measures implemented in response to the 2008 crisis and the COVID-19 pandemic have only exacerbated the problems that Schiff has been warning about for years. One of the key areas where Schiff's concerns are particularly relevant is inflation. While critics may dispute the extent of inflationary pressures, there is a consensus that inflation has been on the rise. In 2022 and 2023, the United States saw inflation rates not seen in decades, driven by factors such as supply chain disruptions, increased demand, and rising energy prices. Schiff's argument is that the Federal Reserve's response to inflation has been inadequate, and the central bank's policies, including its reluctance to raise interest rates significantly, have contributed to the problem. He contends that inflation is not a transitory issue, as some officials have suggested, but a long-term problem that will erode the value of savings and negatively impact retirees on fixed incomes. Another point of contention is the level of debt in the economy. While critics may argue that the U.S. has historically carried significant debt levels without dire consequences, Schiff's concern is the combination of high debt levels with the potential for rising interest rates. In a low-interest rate environment, servicing debt may be manageable, but if interest rates were to spike, the cost of servicing that debt could become burdensome for both the government and individual borrowers. Schiff's warnings about over-leveraging are also relevant in the corporate sector, where companies have taken on substantial amounts of debt to fund operations, acquisitions, and stock buybacks. A sudden economic downturn or a spike in borrowing costs could lead to a wave of corporate bankruptcies and job losses. The devaluation of the US dollar is a point where Schiff's concerns intersect with broader economic discussions. While the dollar remains the world's primary reserve currency, some nations have been diversifying their foreign exchange reserves away from the dollar. This diversification is a response to concerns about the dollar's long-term stability and the potential impact of US monetary policy on its value. Schiff's contention is that if confidence in the dollar were to erode significantly, it could lead to a rapid depreciation of the currency. This, in turn, could lead to higher import prices, lower living standards for Americans, and a reduction in the dollar's purchasing power on the global stage. Schiff's warnings about asset bubbles have also gained traction in financial circles. The stock market, in particular, has seen remarkable gains in recent years, driven by factors such as low interest rates, massive liquidity injections, and investor exuberance. Cryptocurrencies have experienced wild price swings, with some experts likening the phenomenon to a speculative bubble. The concern is that if these asset bubbles were to burst, it could lead to a severe market correction, impacting investors, retirement accounts, and the broader economy. The events of 2008 serve as a reminder of the devastating consequences of a housing market collapse, and Schiff believes that a similar reckoning could occur in various markets. Geopolitical tensions represent an element of uncertainty in Schiff's predictions that is challenging to quantify. While it is true that strained relationships between major global powers can have economic repercussions, the extent of those consequences depends on a multitude of factors and is difficult to predict accurately. Nevertheless, the ongoing tensions between the United States, China, and Russia do create an environment of geopolitical risk. Disruptions in global supply chains, trade conflicts, and potential military conflicts could have far-reaching economic consequences that extend beyond individual nations. Peter Schiff's warnings about the economic challenges facing us in 2024 are rooted in his belief that the policies pursued by central banks and governments have created significant risks. While some may view his predictions as overly pessimistic, it is essential to acknowledge that economic forecasting is inherently uncertain, and the future is shaped by numerous variables and unforeseen events. Thank you for sticking with me all the way to the end. Please like, comment, and subscribe, and make sure the notification bell is turned on so you don't miss a video.